this point. Because this get more into macroeconomics and understand how to navigate and trade the world in a way that we can take advantage of any trends that it may be setting in. Because that's all we basically gonna be doing. So as the world as a whole slow down, and with the US being the largest economy in the world and the largest consumers in the world, that's why if we start to slow down or go into a recession, we can push the rest of the world with us. Even when China was in this little slowdown, it didn't really put us in a position globally. But if the US does it, oh yeah, you can cancel Christmas. So here, what we're doing is observing the world as a whole and what's going on. Because if oil is showing you signs of slowing down and continuing to base down here in these lows, it's just showing you basically the behavior of business and global business. So if we expect the markets to slow or expect a recession or anything like this, we're gonna break them lows. And this will show well before it reflects over in the gross domestic product and the GDP. And months before you will hear anything about it. So this will put you in a position where you can be prepared and looking to, be in the right position and on the right side of the markets, and just being prepared in general to start batting the hatches down and stuff like that. Because it's a lot more than just looking at the S&P 500. Now we've crossed the line in the futures, now taking on this futures class where you can see everything 360. Does this make some sense to everybody?
Yes.
Yes, sir.
This is gonna help you when it comes to your trading as a whole. So, real quick, looking back at stocks versus bonds. Falling bonds yield, falling bond yields is bullish for stocks. Rising bond yields is bearish for stocks. You know, I'm talking about bonds, basically talking about rising, I'm talking about interest rates as a whole. Bonds versus commodities. Rising commodity prices mean higher inflation and higher bond yields. Because to combat inflation, you have to raise the interest rates. And inflation comes into play when it comes to like looking at not just those commodities. You see those commodities, you go back to copper, silver, and oil, go back to that. You see silver still running up. It has an effect on production of things that use this and gonna have higher pricing based upon its use of this commodity. So in this area, this can have an effect on the cost of producing chips or anything that uses gold or silver. Does that make sense? And that's only one sector of the economy. But if you go over to soybean futures, to like foods and wheat, go to the wheat futures.
What's the ticker on that?
I think it's SC. Now hold on. Go up there to the hit the drop down tab.
Where?
And the ticker up there.
Oh, okay.
For the corn right there, it could be the E-mini. When we start talking about inflation, as you can see, if you go back to like the beginning of the year, in January of the, you can see how no, go back. Go back to where you were. Right here. Like from here, if you think about if you was listening to the markets, that's all they was talking about is inflation during this time. And now they was talking about we can start cutting interest rates because you can see that the cost of these commodities when it comes to foods are coming down. This is corn, and corn is used as a byproduct in a lot of different things. All right, come up here now and go to wheat. Hit your symbol up there. Go to soybean right here. That one will work. And you see what's been going on. What side of the bell curve we on? Trying to bottom out now. Go to the weekly. Soybean. All right. Now go to up here. Come down to wheat. And you see most of the foods have came off their highs and on the right side of the bell curve. So the commodity prices that they're referring to is a lot of these foods. This puts us in a position where you can lower interest rates. Is this making sense?
Yes.
Yes.
So this environment, this is easy to take these trades more long term. Because if you see these markets going to continue to move in that direction, and the Fed continues to have an easy monetary environment where it's trying and don't have to worry about inflation, and it continues to cut inflation, that means you're gonna have lower pricing here. And when you trading these right here, in wheat, like let's take a look up there. How many points that is right there?
-5.
-5. When you trade in wheat, everything in the futures market, everything is leveraged.
Just search 2 hours in the bunch.
It's -5 If it moved 5 points, each point, come here and click this. Hit futures and go back to week.
Oh, you love the dollar. I haven't. I appreciate you.
What
Are you sure?
Trust me, go get some lunch. Well, I know a lot, well, you used to be able to get lunch for $11.
No, no, it's true. Thank you so much.
Each tick on week, you got 4 ticks in the futures market.
Well, we sell their mega inspection report items.
Yeah, so.
Everybody follow me?
Sitting right here, you should be good as long as.
The market's moving ticks and in points. And these commodities are moving 4 points. I'm at 4 ticks. 4 ticks makes 1 whole point.
I'm not sure what that means, but I'm trying to capture it.
Just think about it like it's a dollar. 0.25 is 1 tick. And in the futures market is $12.50. Each full point is $50. So you see that number right there?
Mm-hmm.
That 5 represents 5 times 50.
Mm-hmm.
And that's how much money this equates to with 1 contract. That makes sense?
Yeah, I got you now.
Soybean. Is the same as well. Corn.
Is this more for just the like this the what are these called? They're not called. Are they called commodities?
Yeah, these are commodities.
Okay, so then when we're
All of these are commodity futures.
so the commodities futures moves all in point like 0.25 and things like that, and then
No, all of these things move different.
okay.
So we have to identify how each one of them move. Because you have in the futures market, you have index futures, and in the commodities markets, you have index futures, food commodities, grains, oils, and metals. But they all calculate and move differently as far as how you calculate it as far as making money.
What's the hours for the futures market?
They 24 hours. They only close on Saturday. They closed on Friday at 5:15, and they won't be open. They close 24 hours. They close all day Saturday, but they'll be open back up tomorrow and keep rocking. Everything.
That's when you said Sunday at 5. They open up Sunday at 5.
Yes, the futures market, the whole world and everything trades. Stocks, index futures, all the commodities, all the grains, all of the metals, everything. This is how you protect your portfolio on this side. So if something crazy is going on in the stock market, you can come over into the futures market and hedge your position. This makes sense?
What's the example of that?
What do you mean?
An example of hedging your position. If you got a stock or an option or something opened up, but it's something going wrong on that end, how do you hedge your position in the futures market?
if you trade, let's say you got a S&P contract and you long, but the market's getting hit, getting pounded. So you come over there and into the futures market, in the index market, in index futures by offsetting the size of the trade that you have on in the futures market itself. So you might get one E-mini S&P contract to offset your position of your S&P or SPX or SPY puts. SPY calls.
Oh, so what you're saying is if like my S&P 500 getting hit right now, so while it's going down right now, I could have went over to the futures market and then opened up and went long, or should I went short in the futures market?
No, whatever you're doing in the options market, you do the opposite.
Okay, do the opposite in the futures market and I'll be all right.
Yeah, because you're gonna be losing money on that side and be making money on this side.
Oh, okay, I got you.
In the way that futures are leveraged, you should be making the money back that you're losing and some.
Oh, I got you.
That's the hedge.
So that's a strategy that a lot of people use.
No, that's not no strategy. This is just how you trade from hedging.
Oh.
And this is how, like, your goal is always to be able to, because the number one goal is to protect your capital at all costs. Like, everybody come to the markets and look to make money, and that's their first priority is to look at making money. But in this business as a professional, your goal is always protect your money. Because if you don't protect your money, you don't have any business. Because your money is your business and your money is your inventory. And without no inventory, you don't have no business. If you just focus on just making money and not looking at anything, it's like having a Walmart store and and you right in the dead center of the hood in Atlanta, just open it up. Well, not just a hood, just an area that just crime infested, that everybody out trying to make a move, car break-ins and thefts and retail thefts is at all-time highs. And you open up a brand new store and don't have no type of store theft prevention in there. How long you think that store gonna stay open? And I'm talking about you got everything in there. You got designer, everything. You ain't got no security, no tags or nothing to protect if you go outside. To go off as an alarm, talking about nothing. You just open the store. How long you think you're gonna be in business?
How long?
It may be a good idea, and you're gonna get a lot of traffic for sure. But how much of that traffic gonna turn into profit versus loss? That's why when y'all hear me and we be doing these TA classes, like the number one goal is asset protection. Don't focus on making the money. Follow the process of protecting the money while you get to the money. Because if not, if your number one goal is somebody making money, you're not gonna protect your money and you're gonna lose. So focusing on the process is the key.
I got a quick question, then.
Yeah.
I want to see the S&P 500 mini future or whatever you call it. I want to see how that looked when the S&P 500 was getting hit. If you don't mind.
Come here, Josiah. Come here. Come here. Come here. Come here. Come here. Come here. What do you want?
Yeah.
What do you mean?
Like I want to actually see the chart of the mini or the opposite of the S&P 500 future.
So I'm saying this. I'm working on the call.
You know what I'm talking about?
You want to see the opposite of it? What you mean?
Yeah, I just look at it on my chart. I'm gonna just, you know what it's called on the future side?
No, I think you looking at this wrong.
I think you're trying to say what SPY looks like versus ES.
It looks the exact same.
It's the same thing. Coach, I got a question regarding what you just
It's
said.
the same exact thing. That's why I had y'all looking at that in the options class. It's the same exact thing, but it's just a different instrument.
Okay.
Coach, can you hear me?
Yeah.
I got a question. Like for example, like yesterday I was in a put on Apple, right? And Apple was going up. So like would the right hedge be to like buy a buy side in the NASDAQ or the SPY because Apple lives in both those indexes? Like, is that the type of hedge you're talking about?
Yeah, you can do that. But if your money, if everything's going good, there's no need to put no hedge on. It's to tie up extra money.
I mean, we didn't really get it in the top, though. I mean,
okay.
You got it on the smaller time frame.
When do you hedge? You hedge when you got in at, like, basically not sniper shot, but got in very, very good, and you see it hit a level like the 618, and you still think it's going to continue to go down, or like when do you hedge?
Let's say the markets open up overnight, and you see things are looking bad on the opposite side of what you're doing. I mean, going opposite of what you're doing. So you'll go into the futures market and just put on a trade to protect that. You don't necessarily have to.
I see what you're saying. You're basically saying just do that until it's going back in your favor. What you're saying. So correct. You can protect that capital. I see what you're saying. All right, thanks.
Hold on one second.
Also, while there's a whole, I learned this as well. Those who know how to hedge, you gotta have 2 million in liquid to talk to anybody who know how to hedge. So no, this is not everybody know how to hedge.
What did you say, Charles? You said those who know how to hedge what?
If you talk to any financial advisor that is a hedge fund, you gotta have 2 million liquid before they say a word to you. Not 2 million asset, 2 million liquid. And then like Paul Tudor Jones or someone like that, that's what I'm talking about. Or
asset managing, that's true. I was just talking about in terms of like this kind of preserve what I had already going. Because with the future, you're not gonna hold it overnight anyway. So it's a day trade to begin with. So I mean, just for that day. Because the overall trend is going one way. So you might get a day going the opposite way just to continue back in pattern. So just to kind of like hedge, so you don't really give all that money back. That's kind of what I was getting at.
No, exactly, Dexter. No, I don't try to tell everybody that. It's like Paul doesn't know how to think, that's all. So you're right.
You know, something didn't make sense to me about when he just said that the S&P 500 gonna go the same way as the S&P 500. It doesn't make sense because it should go the opposite way. If you're supposed to be hedging against it.
Well, what you see is that the future moves faster than the equity does, the index does.
And I think he's confusing when Daniel said that it's the inverse, but he was specifically talking about on the example of like, if I were to be in an options contract and I was in puts, then if I was losing those puts, it would be the opposite in the futures market. So I would try to go and catch some calls or some buys.
You would go long in the future market.
But no,
Right.
you're not gonna go long in the future market because you can't hold it overnight. So it's basically like if you already
It's
making money
24/7.
in your, yeah, but it costs. They're going to explain to you. It costs a lot to hold it overnight. It's not like an options where you have your delta, your theta, and your like you have your Greeks. It's a lot more expensive. So I think what he was saying was if you're already in a winning position and you're giving back some profit, you could go back over there to the futures market and catch a day trade going in that direction. So it kind of washes out what you're losing.
It's confusing.
Yeah, it just take a little to get used to it.
The reason why
I think that,
and I think Dre, I think he was almost getting how I'm looking at it.
Yeah.
Because I paper traded the S&P 500, but I guess whatever going on, the markets was going down and crashing and crashing. So I'm under the assumption that when I get on the ES 500 minis or futures, whatever, it's gonna be going on an uptrend. So I can go long and get my money back.
Right. And all the markets are
saying
the same. So you're gonna be spot on the same chart, every chart. But
if you trade in the ES, if you trade in the SPY, the ES is doing the exact same thing because the ES is just the ETF of the SPY. I mean, the SPY is just the ETF of the ES. So it's the exact same chart.
Yeah, you see, you gotta see. This is what, like, from the TA class when they made it, or made the indexes. Kobe, you can pull up the SPX. Just the index itself. You see how I just say the S&P 500 index? This is the actual index.
Right.
Go to the SPY. This is the ETF of the SPY. This is not the actual index. This is the tracking stock of the index.
Okay.
You probably already answered this question, Daniel, but I may be asking the same question that they're talking about. But so between the two, is not that you trade one or the other? Because you're
Hold on, it's not two.
Huh?
It's not two.
It's the same thing.
No, it's four.
No.
Put in / ES.
So it's the index, ETF, and then future. It's something else.
Click that. That's the futures. You see what I'm saying? It all looks, it's the same. The pattern, it tracks. Everything is the same. It moves the same.
Gotcha.
Pay is different because it's in different markets, a different product. Now type in MES, M / ES.
MES.
Yeah. You see, it keeps giving you different names.
Mm-hmm.
It was the S&P 500.
Mm-hmm.
But that's the same pattern now.
All this these are derivatives off the SPX. The SPX was the first thing created in the 80s.
Okay. But let me ask you.
SPX.
So type of SPX.
Yeah. This is the index itself. And all them, the SPY, SPX, MES, ES, and the futures index standard as well.
What a question. If this right here, if you bought some calls on this S&P 500 and they start going the opposite direction and you start losing, how would you go to the futures market and offset that? What would you do in the futures market?
You got to short it.
So I go short in the
If
futures
you go
market.
on the opposite, if you bought calls on the SPY or the SPX,
Right.
and the markets are going down,
Right.
you losing money. So you gotta go short in the futures market. Right, like on that. But you still, your interest and everything still it's not like it's just a save all button that you hit. You gotta still use your same concepts and skills from over there. You still gotta hit the same sniper shot in the way you do it. You still gotta have that concept. You just can't just blindly start shorting the SP, the ES, and just go back to sleep.
That makes sense.
It don't work like that. You still gotta have your game on, have your helmet on, all your gear and equipment, and be ready to get out. Because if it were that easy, everybody would be doing it. Like, oh shoot, I just trade futures. It don't matter what I do. If you think that's gonna happen, you're gonna get your head cracked. Because one thing about the futures, let me tell y'all this part first. When the futures market was first introduced and created, Wall Street is known as the greatest game on earth. Options is the most sophisticated tool. Futures is where the most professional and successful traders play at. And they call it the land of the quick and the dead. They call it the land of the quick and the dead is because in the futures market, this is not like the options market. You're going to sit back and wait to get paid. As soon as you take this trade in the futures market, you're either making money or losing money. And you're going to lose it fast or you're going to make it fast. And I'm talking about as quick as you snap your fingers. If you wrong in a trade in seconds or less than a minute, you're going to be stopped out. That's why they call it the land of the quick and the dead. You will blow if in the stock, when they talk about people trying to learn how to trade, they blow their accounts in 90 days on average. In the futures market, it happens in 1 week. So let's make so when you come over here in this futures market, you definitely have to respect the game. They're not gonna come in and let you bleed out. They're gonna just put you in the guillotine. Everybody understand what I'm saying?
Yeah.
You cannot play no games over here.
So what's a good stop loss to always use if it's moving that fast?
But see, that's the thing. This is not a place where you just have, the only thing standard over here is the foundation of how these markets work.
Do they got a turbo trader for futures, the in and out quick?
No, you can be able to, in the futures market, you're gonna be able to set your stop losses. You're gonna hit your TP1, TP2. I'm talking about you're gonna be able to set TP1, TP2, 3, 4, 5, 6. Like what in this futures market, anything that you want to do as far as putting orders in and stuff like that, you can do it at every level. In this futures market, you can have pre set orders. When you first get in the market, you can have your stop, TP1, TP2, all these preset orders, all different types of conditions. You can set things up based on reports when if-then type orders. You can put orders in like if the Fed get ready to make an announcement, it can kick you out. That's like anything. But the way they operate and this leverage and things, you just got to understand how these markets work so that you can properly take advantage of them. This is just bringing everything 360, what y'all been learning. Now, when we start looking at, now you're going to really start paying attention in the news when they talking about interest rates, when they talking about commodities and food prices and things like that. When we start looking at the US dollar, pull up the US dollar. /D, man. Yeah, I got a brain fart, can't even. It's not USD.
What's that?
EXY?
Yeah, that's it.
Gotta put a dollar sign in front of it.
$.
Right there. It's the US dollar cash index. Go to the daily.
Do they got something to do with Forex?
Forex is currencies. It's just a nickname. If you trade any pairs on the any Forex, if you're not following US dollar, I don't know what you got going on or who's taught you what you're doing. You see how the dollar's been on the right side of the bell curve? Rise of commodity prices equals higher inflation, which is good for bonds. So the bonds itself, higher bond yields and interest rates gonna rise. When you're looking at this from a commodities and currency standpoint, you have a strong dollar equals weak commodities. A weak dollar equals strong commodities. You see the dollar's just been getting hit. From commodities as a whole, like looking at gold, copper, and metals, their move is still strong. When you have this US dollar continuing to get weaker, it has an effect on these commodities, and which in turn goes back to the bonds, and which in turn goes back to the stocks. That makes sense?
Yes.
Did you feel any guilt?
And this goes, we trading beyond the charts. And when I say we trading beyond the charts, meaning you can be the coldest technical analyst on the planet, but if you don't know how this stuff works, but you got to come off the charts. Like, okay, we see the US dollar trending like this. The metals markets are bullish. Commodity markets in the wheats and grains are bearish. The bonds go to TNX.
What are we doing? These are futures. This is the interest rate. You got to move the decimal. It's 3.985%. Yeah, the rates are going down. Looking at the picture, looking at the four key market relationships. Interest rates are going down. I mean, bond yields are going down. Commodities are going down. Oil is going down. Food is going down. Do you think we have an inflation problem right now? Right, Chip?
So with all those things going down, you said because those things are going down, is technically we're not in inflation. So based off of the news or people saying, you know, financial issues is meaning that we're in inflation, but just coming here and looking at those, forget what you call them, but those instruments that can tell us that we're not in inflation. I mean, not in inflation, not in a recession.
No, we're just looking at inflation. Now, if you start looking at it from a recessionary standpoint, in a recession, everything starts turning down. Gas are not going to be nowhere to hide. Every commodity, every instrument, every security will be getting pounded. Everything.
Does it matter over a certain amount of time?
No, it can happen from like 6 months to 18 months or longer. Don't nobody want to see that. I don't know if y'all old enough to be able to remember 2008 or working. I'm talking about when you had a job and real responsibility. Because they had to put a thing in place where they was giving everybody stimulus checks weekly through the job, through unemployment. You was able to stay on unemployment for 24 months. Because it took on average of 2 years to even get a job. Can you imagine that?
Yeah. I never quite understood it before, and I used to hear about it, but now that I'm tapping into this world, I get it more.
You trade something like that, just buy puts.
No, we're gonna be on top of it. Just like how all this stuff moving now, you could have been short the bonds right here. I mean, right there. Go back to the US dollar. You could have been short the US dollar from up here. 1, 2, 3, 4, 5 areas. Go back to wheat or corn.
Write this down. You remember what the, let's see, let me go corn, I just seen it.
Go to cocoa, any food futures. Cocoa futures.
Cocoa. All right.
Any one of the food futures.
Hey, who upstairs? Taylor right here.
Lean hogs, you can go there.
Julius, this ain't the TV for you.
You can short this stuff.
Go ahead.
Thou shalt not eat the swine flesh, but we can short it.
Now, when you look at, like I use Forex Factory, I don't know where you look at your economic news, but are some of these the indicators that they're using to like consumer goods and things like that, those red folders?
Yeah, that's what they're measuring a lot of this stuff for.
Jayla.
Yeah, we're in an inflationary, but we were in an inflationary environment. The Feds have now currently got it somewhat under control. So that's why they was able to lower the interest rate.
Okay.
But they're trying to walk a fine line because in certain pockets of the economy, we still have inflation, as you can see in the metals market. So they're just trying to walk a fine line and balance everything. And so they don't want to end up overdoing it and doing too much. Because if they continue to lower the interest rates to stimulate the economy a little bit more, it may tick up inflation a little bit more than they expect because they're trying to keep inflation up under 2% around that area. Is that making sense? That's why you keep hearing the Feds and when they talking like they have a 2% target that they're trying to reach. And as long as we may not be at that 2%, but as long as we within that a stone's throw of that, they are something satisfied. So they're going to be doing things to try to offset. But as you can see in the foods and grains, the markets and inflation came down. But what's putting the pressure on the inflationary side is the commodities when it comes to metals and producers. So it's keeping the cost of a lot of goods up. That makes sense? So it's a balancing act.
So, Coach, if today was Sunday at 5 o'clock, what is your your process or your walkthrough when the futures market open up?
You just look at the market, see what's going on. You do your homework as usual.
Do you look at anything first, like between commodities and or oil or gold or anything?
No, start off regular, looking at the index. Always got to look. Everything starts with the index.
Which one is like spot, when you trade an option, SPY takes 80% of the market. Which one like that in the futures?
It's the same thing.
Like they don't have a Magnificent Seven of the futures.
No, it's the same thing. Everything is built off of the actual markets itself. You know, the stock market was the first component. That was the first market, and everything else came later. In order to hedge and protect. And what I'm just trying to get y'all to understand today is how all of this works.
Is gold and silver and oil and stuff like that? Is that a part of the indexes?
They got their own index. You got the gold index.
Oh, so they ain't got no indexes with each other, like gold and silver not on no
Oh no,
index together.
we don't get to all of that. They do have an index for the futures. But right now, I need y'all to understand, like, if you see gold moving one that way, or you see bonds move one way, like, this is how, if everybody go back to my screen, I just wanted to show you how the full market, how these full markets correlate with each other in a relationship. Relationship between stocks and bonds, bonds and commodities, commodities and currencies, and commodities and stocks.
Where you look at bonds at?
No, don't worry about what to look at. I need you to know this core information first. If you don't know if bonds are rising, how that'll affect the stock market, you got a problem. Is this making sense? Everybody looking at my screen?
Yes.
Just we talking about stocks and bonds. Stop thinking about how to make the money. You need to understand how this works. Or what to buy, or what to sell, and all that. Right now, we're just trying to get through the introductionary areas of how stocks and bonds operate. Falling bonds is bullish. Bond yields is bullish for stocks. Rising bond yields is bearish for stocks. That's one. Bonds are tied to commodities because rising commodity prices meaning higher inflation, and what you're gonna have higher bond yield, which is bearish for stocks. You see what I'm looking at? This goes with this. So knowing this, puts you in a position where from a long-term portfolio protection, portfolio building process, know what you need to be doing here. There's gonna be a lag time, but you know what to do. Commodities and currencies. This currency is tied to the yields with the dollar. A strong dollar equals weak commodities.
So I just gave you some chips. That's all, they all gone. Okay, I will buy over.
And you can also look at
Watch Dora.
interest rates. When they're raising the interest rates, that's also make a stronger dollar. Which make commodities weak. Weaker dollar, stronger commodities.
Leave the TV alone. Cut on Dora. Leave it alone. If you're gonna be in there and watch Dora.
Rising commodity prices put pressure on stocks, which is inflationary. All of commodities is friendly for a stock environment. Why? Because commodities are cheaper and it's cheaper to produce products to buy the actual commodities and things at a cheaper rate. Does that make sense? Because this goes beyond just looking at stocks. This goes behind the operations of how macroeconomics operate and how to actually take advantage of that. And it just puts you and give you a clearer, more confidence in what you're doing in these markets. Because in a lot of these commodities, they start trending and they trend for a long time and don't break like a stock just randomly. Old earnings report come out and it gaps up and try to change direction.
Please go upstairs and watch Dora. What's wrong?
Kobe, do you go to
Okay, your brothers
to the
is
soybean?
upstairs. They'll help you.
One of the
Just give me a couple minutes, George.
foods?
All right, yeah, hold on a second.
Put her some shoes on, please.
Don't go downstairs. Stay upstairs.
I'm typing in like that.
You can do wheat, soybean, corn, I don't know.
Get upstairs.
You can
Get
even
up,
do
get up,
silver
get
and
up.
stuff on the commodities.
Put some shoes on, won't nothing be wrong with your foot. I said I'm gonna get you a snack and I'm gonna get you a surprise later. So take the foot upstairs and go watch Dora. I'm not playing with you no more. So go watch Dora or go lay down. What you wanna do? What do you wanna do? What do you
Go to the weekly.
Okay, so go do that. I'm gonna order some chips and I'm gonna get you a lollipop, okay? What color lollipop do you want? You want red,
And
you
don't-
want 1 or 2?
You see how long term the trends are on these things? Like if you catch one of these, you can be in them for years.
I need you to go up there and finish watching Dora. Thank you. I love you. Sure. You don't wanna love me?
You see what I'm saying?
But you want me to get you a lollipop? Okay.
It's a different type of, it's a longer process. But just imagine you was short from up here. At one of these key levels off the weekend. Just after the dead cross, hit the 200. Even if you just had 2 contracts, or just let one run. It's just a different type of trading. And it takes time for the trends to, it takes a long, they trick these types of trends in these markets. It takes a while for them to set in. And once they start trending in that direction, it goes for a long time. And it takes time to turn around. Is this making sense?
Yes.
So understanding the relation to key relationships between stocks and bonds, commodities and currencies, bonds and commodities and stocks is key. Because you got to have a more macroeconomic look and take a step back and look at the world itself and see how these markets are operating. Is that making sense to everybody?
Add it up.
Yeah, so far so good.
All right, let's look at the business cycle and the market phases.
What should I go to?
Go to my screen.
All right.
In the business cycle, we got to be able to see and look at where we are. visually, it'll look something like this. In the business cycle, right now, this is how we look. Based on the charts we're looking at, we all agree with this order.
I'm gonna just go to the what 30 minutes downstairs inside of my computer. That's fine. Okay.
It's not right. This going to be the zero line going straight across. Anything previously, we had this one. We had a strong dollar. Strong stock market. Commodities. We had strong dollar, strong stock market, commodities was on, everything was on the left side. And you see commodities last. But now we got commodities typically on the last one in the late cycle. Commodities peak, stocks decline, bonds rally. In the early cycle, bonds rally first. Because why? If bonds rallying, what are the if the bonds have an inverse relationship, bond pricing have an inverse relationship to its yield. If bond pricing are going up, which way the yields are going? Let me get your answer in the chat. That means it's going down because interest rates going down. If interest rates going down, we have a low inflationary environment, and the Fed uses lowering interest rates to stimulate the economy. Lower interest rates and bonds are bullish for stocks, right? Everybody follow me on that? So the stocks gonna run, then commodities gonna come behind them because businesses are picking up and the purchases of goods and commodities and production of those goods. This is making sense? Mid-cycle, stocks gonna start to peak as inflation rise. Bonds start to get weak. Because we're gonna have to start raising interest rates. And that's gonna put a damper on stocks. Late cycle, commodities peak. Stocks start to decline. Like here, we got commodities at the top. Now, Kobe, if you go back to the charts, go back to gold, silver, and copper. Pull that back up. My chip.
Oh, my bad. I thought my screen was sharing.
Coming in good for Costa Rica.
All right, cool. So you should be able to see my screen. I'm on gold.
And you see how I have it on my screen? I got commodity peaking. Stocks, we already know been getting hammered. Bonds haven't started rallying yet. They still getting hit. So this just the flow of the way the economy and the business cycle works. So you should be expecting some type of slowdown. Because once these commodities peak, everybody gonna be starting running for the hills. But what the Fed trying to do is make this a soft landing, organized, not just a recession where everything just hit the fan and just people start panicking. When Trump keep messing around with these tariffs and all this stuff like that, we can easily be derailed and force us into a recession. This is last year. He already told everybody we may have to go through some hardship for a little while. So put your seatbelts on. People don't understand exactly what he's saying. Like, shit, you gonna have to buckle down. Gonna be some people losing some jobs. It's gonna get hard. But as you can see, we're in the late cycle anyway. And these business cycles last for years. But this just gives you a more idea of like, you can visualize and see where we at. Clearly you see the commodities are doing what? You get your answer in the chat. What the commodities doing? Or metals at this point? They still running. They still bullish. Now, when you start seeing all these other commodities start rolling over, Oh yeah. You can scrap your seat. You can put your helmet on. Put your mouthpiece in. Tighten up your chin strap. So we going. No, all commodities gonna get hit. Because the demand for everything is gonna slow down. The cost to move goods from A to B, people gonna start slowing down from this. A lot of people they gonna stop taking orders. You'll start looking at the producer price index and start coming down, looking at PPI, consumer price index and CPI, and then start measuring how long goods. Because what happens is we track how long it takes to produce a specific item and how long it sits on the item. It sits on the shelf. The first sign will be inventory levels start to get high. And as the inventory levels start to get high, that just show you that the goods aren't moving fast enough because the consumer isn't consuming. That makes sense to everybody?
Yes.
The role of the US dollar. A strong dollar benefits bonds and hurt commodities. A weak dollar support commodities and pressure bonds on the key global trade and emerging markets. Pull up the Hang Seng.
Pull up what?
Hang Seng Index.
Hang Seng?
Yeah, go to click up there. Yeah, hit the drop down tab. Go to indexes. Indices. Go to Hang Seng.
Missing anything? Excuse me. I don't see
I'll go to futures. It's not in the US one.
Gamble, from you looking at the charts and stuff as of today, what do you think we're heading with the economy, short and long term?
We slowing down. It just depends on how far we're gonna slow. That's the question.
Yeah, I don't see Hang Seng in futures either.
Yeah, isn't it going back over there?
Is that it? And Hang Seng.
Hold on, sorry now. You can use the one up the top, the emerging markets.
This one?
Yeah.
That one didn't work for me. Some futures. Let me see. Let me look it up. It's right here.
Yeah, that's it right there. You see what that market is doing, right? What is it doing? Digital. He's running, right?
Like he's running. He's high.
This is what we're looking at in emerging markets, which is key for global trade. Now, the way all this works, this is why you see this Chinese index and stocks are going to the moon. Like, look at stocks like Alibaba. Like, just look at it from this perspective. Go to the daily chart. Zoom in. Go to January 20th. Zoom in from right here. What date is this?
March 14th. No, January 10th.
What date is this?
January 22nd.
These buy areas. Ever since Trump came in, these emerging markets, look what they've been doing in the position of the US dollar and commodities. Look at the slide I just showed you. Understanding that ebb and flow lets you know where to go. Like, pull up Alibaba. Daily. You got this look like it's up there against the zone, but this can easily be a symmetrical triangle. We break out at the top, this thing gonna keep running. Because the position of the overall markets of the US dollar and global trade in emerging markets and the effect of the bonds and things. Is this making sense?
Yes.
It's like a big puzzle that you're putting together. So homework, I just need y'all to master and understand a rising dollar affects what? Rising bond prices affects what? Remember the key securities that we paying attention to
Look at your shoes.
and how it flows in the business cycle.
They keep changing the TV.
Looking at the 4 major asset classes and how they relate.
When you're talking about the key securities we pay attention to, are you talking about the 4 asset classes?
Yep.
Okay.
And I know y'all thought y'all would come in and get straight on charts and all that stuff there. But y'all know we be doing things on another level.
Why you can't do that?
Yeah, the macro is economics, something I needed to learn anyway.
You can't trade futures without that.
Okay, go ahead. Take your bracelet and go upstairs.
They're gonna put it.
Get her some shoes.
You ain't on top of that.
But you really put some things together for me, so I appreciate that economically. You know, as far as like if bonds go up, what happens? You know, stuff like that. So now I can read some news and have a better understanding of what's going on.
Oh, y'all gonna be junior economists by the time this class over with.
Later on, are we gonna figure out where we look at bonds at?
Yeah, we're gonna look at everything. I just need you to know what's going on and interpret these early first.
You got any suggestions on any books, learning material that I can buy and kind of books I can learn about macroeconomics?
I really haven't read one book in one place with all this stuff. I don't know not one book that can put everything together like this.
You can have a conversation with Chat. Chat GPT.
Hey, Coach, do you mind if we take a screenshot of that one bullet point you had that showed all the commodities and everything that what affected what?
Which one?
I think it was like maybe the second or third one you showed.
This one? Well, this basically gonna be your homework.
The screen didn't change.
You can click it at the top to switch over.
You gotta click my name. Like we gotta stay with the class, like what we're covering, all the stuff everything is gonna be covered. You gotta stay where we at in the class and focus on mastering and understanding what we're talking about today. Cause trust me, you get down in line and start looking at trades and stuff like that, and you don't have no clue on how to put all this stuff together, we're gonna be talking over your head so far, it's gonna be like, man, I don't know what's going on with it. Because a lot of your trades is gonna be based on some of this stuff right here. Then that's when you're gonna have to start looking at the technicals and looking at the trade itself.
I need the keys.
If you don't have this fundamental stuff down, how are you gonna be able to
Use the
compete?
keys, okay? Go with brother. Okay, Jared, just go upstairs.
That makes sense to everybody?
Yes, sir.
Boy, we gonna be cold, boy.
I haven't been in this class since 2018.
Go ahead.
Sheesh, I'm going on year 3.
Oh, everybody in this class been around for a while. It's gonna bring y'all 360.
Yes, sir.
This is not something, and this is why I do my classes in stages. This a man trying to teach you, somebody that hasn't been in none of the classes, trying to come to the futures class. They would get this stuff right here, but then when we start getting into activation and execution, they're gonna be lost.
We could put 2 and 2 together.
But we'll get ready to wrap it up right here. We'll get back on here tomorrow. Same link, same time. Make sure you do your homework, because we're gonna be talking about a lot of stuff. You're gonna be looking and reading different things that you need to be able to interpret and see, because we're gonna be operating at the highest level.
Your juice is upstairs, Shalom. I gave you juice earlier. It's upstairs.
Because when we get done, we can have people right in our face, sitting right here next to us, and we'll be talking about putting trades on and executing trades, and they won't even know it.
You like it? Okay.
And if they see you put the trade in, they won't even know why. Because I might just say something about interest rate. I see interest rates over here down at 230 seconds. And the futures just ticked up. They don't know what that means. The yields ticking down. And we see the markets itself and the S&P ticking up. That's textbook.
That's right. I posted it in from midweek's news chatter from the work that I did, where I can tell now why they seem to be getting ready to a full cycle from this day class here.
So make sure you get your homework done, and we'll get back in here tomorrow and keep it pushing.
All right, sounds good.
Right, anytime, have a wonderful day.
Thank
All right,
you.
y'all be enjoy your Saturday.
Buenos dias, everybody. Buenos dias.
Thank you. Thank you.
Appreciate you, Daniel. Good information, bro.
Okay, don't swing. Come on, let's go.